Financial resources, tax expense, social insurance, and voluntary contributions. Hello. It's a social welfare study channel, Social Welfare Insight. This time, we're going to learn about financial resources. Concept of financial resources. Precautions for financing, types of social welfare resources. Taxes, social insurance premiums, tax methods and social insurance premiums. We're going to look at it in the order of tax expense, usage fees, and voluntary contributions. The concept of financial resources. The financial resources are the process of creating and allocating the costs of implementing social welfare policies. It is the most basic prerequisite for the planning and implementation of social welfare policies. It's necessary to secure financial resources. When you turn a policy into a specific business, the procedures for the policies implemented are shown as expenses spent on specific items. It is evaluated on an efficiency and appropriateness basis. This leads to an evaluation of policy implementation. For the precautions related to financing, the size of social welfare finances should be determined at a reasonable level, taking into account the ability to bear the national economy. Among the various financing methods at the detailed level, the economic impact can be minimized as much as possible. The value ideology of distribution policy must be faithfully reflected. Social welfare resources include public assistance, social insurance, and social services. The public assistance system is based on the general tax of the state. It supports the cost of living of low income people who maintain below a certain level of income. The social insurance system operates insurance premiums paid by policyholders as expatriates. Expenditure is incurred when a reason for payment of insurance benefits occurs. Social services are facilities that operate social services and social welfare programs. Subsidies are provided to organizations using financial resources raised by the state through general taxes. Donations, and user contributions raised by the private sector will be used as financial resources. Taxes are a kind of levy imposed by the state on individuals and corporations. Payment methods are divided into direct and indirect taxes. It can be divided into income tax, property tax, and consumption tax. The tax it is collected and used in different ways and forms, depending on the political, economic, and social purposes of the country. As a basis for paying taxes, it is easy to achieve the definition of distribution, and it can broaden the scope of social welfare policies. There's less discrimination in the amount and quality of pay, and there's a steady supply of resources. Social insurance premiums. Social insurance premiums are a quasi-tax of Social Security. Social insurance premiums are for all citizens. Since insurance principles are applied as a Social Security system against universal social risks, it is covered by insurance premiums paid by citizens who are subscribers. Social insurance is when people lose their income in the face of social risks. With the aim of maintaining previous market income, it is common to determine the amount paid in conjunction with market wages or income. Social insurance premiums aim to redistribute income, but the effect is not high compared to the tax method. Let's find out the characteristics of the tax method and the social insurance method. Tax method. The tax method generally has a great income redistribution effect. In view of the tax structure centered on progressive tax, the progressive tax method and unilateral transfer of income, it contributes to social equality. By linking the functions of social welfare policies, it is relatively advantageous for the low-income class. Through personal deductions, etc., it functions as a community of risk among people who are capable of taking on social risks. Finally, by not separating the finances for individual policies, it's possible to coordinate between various policies. Social insurance premium system. Since the social insurance premium method is directly purpose-oriented, financial stability can be maintained. It is relatively easy to link to policy objectives. There is an advantage that there is no stigma effect, because the right to receive benefits automatically occurs due to the withdrawal of insurance premiums. Social insurance subscribers have the authority to officially participate in insurance operations. If insurance premiums are set aside, they can be used as public funds for public purposes. Finally, let's look at tax costs, usage fees, and voluntary contributions. Tax expense. Tax expense is the reduction or exemption of the tax to be paid. It's a way to indirectly support social welfare policies. There are ways to reduce taxes. By reducing donations to social welfare facilities from individual income, it's not about collecting taxes from taxpayers. From the state's point of view, the cost is high, and the income redistribution effect is significantly reduced from the various spheres of the state and the private sector. It's a way of finance to achieve social welfare policy goals and intentions. Fees for use. Fees are paid for the use of facilities by the private sector, which is the main agent of social welfare. The private sector is increasingly mobilized for the inherent inefficiency, overcoming, and institutionally unaffordable residual welfare needs of the state sector. As social welfare providers become diversified, private user fee collection services are increasing. Voluntary contribution. The voluntary contributions that have been formed and developed through citizens' voluntary nature, excluding inefficiency and bureaucracy in the national sector. It's an effective area to rule out the inhumanity of the market. In this session, we learned about financial resources. In the next session, we're going to see the emergence of the social welfare movement. I hope you had a great time. If it was helpful, please press like and subscribe. And it will be a great support for producing the video. Let's be together next time.